Hey everyone, welcome back to Trader Chats. It's Imran from Options Insight. And today I've got a good one. I've got Tommy Thornton here from Hedge Fund Telemetry. You may know him from Real Vision, similarly to where I appear every now and again. Tommy, great to have you here. How's it going?
Everything's good. I'm delighted to be doing this with you. I'm a big fan of yours.
Likewise, Tommy. Definitely. I always want to know what you're up to, which stocks you're shorting, because you seem to be one of the few out there who's still brave enough to sell stocks in this crazy market. Huh?
I don't know if you call it brave. Maybe crazy would be a better term for it this year. But yeah, it's been interesting.
Tell us a little bit about your background then. I mean, you've obviously been trading for a long time, much longer than me, I'm sure. So why don't you give the viewers a little background on your career?
Okay, where do we start? Well, let's go back into the 90s, early 90s. I joined the business with a large brokerage firm, and I became a trader for a large group of private client investors, and we covered entertainment people. We lived on the West Coast. We covered some hedge funds, and as it turned out, in 2000, I left the brokerage side and joined a hedge fund, a $1 billion hedge fund. I was the head trader. I did that for a few years. That was when the tech bubble burst, and the hedge fund did great, but unfortunately, the main company was long only and growth oriented, and that did not do so well. From there, I started my own hedge fund with another partner. We did it for a year and a half. His wife got pregnant, and he said, I have to go back and work for a mutual fund and make real money, and he did. And then I got recruited to move to Greenwich, Connecticut, packed up my wife, 3 daughters, worked for a startup hedge fund, about 500 million, and I was there for 11 years, and we did pretty well. Yeah, we ended up with about 5 billion under management. And then after that, I ran a family office for one of the founders of the hedge fund, and then raised some money for Alibaba when it was private. Started Hedge Fund Telemetry, which is basically research that I did daily and weekly while I was a partner at the hedge fund. And I love it. It's been great. It's been since 2017. I've got lots of subscribers all over the world. I put out 3 notes a day. It's a lot.
That is a lot. Oh my gosh.
Yeah, it's hard. And I have like trade ideas and a lot of different stuff that goes into it. And basically, I'll give you the reasoning for telemetry. I'm a big Formula One fan. And Formula One cars in the early 90s, they started to put sensors on all the different pieces on the car. And then when the car would come around the track past the pits, all that data would be wireless transferred to the pit and with all the computers. And they basically would take that data and then formulate a plan for the driver. So it was like, oh, your tires are too hot, conserve fuel or whatever. And I look at it like I get a lot of data from all over for the markets. I condense it down and find out what I think is going to be actionable for the markets at any given time. So that's sort of the telemetry name. But that's
I like the metaphor. I like the visualization of the racing car. It's funny actually. It's a very similar story to me and why I created Options Insight, or certainly the version of Options Insight now. I created my volatility dashboard, and that was born off the idea of having like a cockpit where you're flying a plane and you've got all your dials and gauges basically telling you how to navigate the markets and do it via trading options basically. So it's a similar sort of story.
Yeah, exactly. Well, look, we're in front of screens all day. I have 3 giant screens that are curved around me. And so this is, home for me. This isn't my home, this is my office. It looks like a home. But my wife's an interior designer, so it looks like, but come over here and you can see like the messy stuff.
So let's talk trading then. Obviously you've been on the buy side, very seasoned by the sounds of it, know what you're doing, been around a long time. So what sort of time horizon do you tend to focus on in your trading, and what do you think gives you an edge in that? Like how have you cultivated that edge, and why do you do that basically?
Okay, well, so our hedge fund was a long short equity hedge fund. Traded technology and media and internet. Those were my focus, but I would do more of a top down look at overall every market, from currencies, commodity, bonds, and stocks. And for me, you develop your own personality and your own process of what works for you. And basically what I have done and created that works well for me is basically look at, weeks to months type of trades. Sometimes they're a lot faster. If they develop faster or they don't work, they're gone. And so I really am very, very conscientious of understanding the time frame in the market. I trade long and short. I can be net long 50%, net short 50%. I have a small fund that I manage, and so I'm constantly doing things. But I look at, again, top down. Sometimes it's an earnings preview that I will get, and I'll do analysis on that with example. Like, for example, I'll look at short interest. I'll look at put call data on a particular stock going into earnings. Sometimes when you see like really heavy call buying, I think that the positioning could be offside and it could fall. If you see heavy put buying, you might have a upside squeeze opportunity. So sometimes they're short term. I like to try and hold on to things as long as I possibly can. So I'll have some things that are very core in nature. I have a fundamental background as well as not just technical. So I'll combine a lot of different things and
right.
My
so you mentioned the sentiments. You mentioned like positioning and sentiment. Is that something that you're always fading that, or do you sometimes go with it? Like, do you sometimes trend follow, or is it generally you feel more comfortable taking the other side when you feel the sentiment's gone too far?
Okay, this is really sort of the main process of what I do. I look at DeMark indicators, which are exhaustion indicators. Tom DeMark also has some momentum indicators that not many people know of and talk about, but that's more of an offensive type of indicator. But what I like to see is I'll go contrary if, let's say, that everything's falling apart in the market, and I'll get a DeMark buy signal, and usually it's what it's saying is the sellers are about to exhaust themselves. And if you don't have these indicators on your screen, it seems like, well, why would you be buying at this particular time? And I combine that also at major inflection points with daily sentiment index data from Jake Bernstein, and the DSI data comes out every day. I think it's highly actionable, but sentiment I think is really important. People don't use it properly because it's a condition. It's not necessarily a trigger. So I will, if sentiment gets to certain extreme levels from 0 to 100, and for example, the Nasdaq hit 93% bulls last week at the peak on the very high day, and we had a DeMark sell signal combined with that. That gave me a pretty good reasoning position short. And not everything is going up from those levels on me right now today, but that was a good general read. And on the other hand, a lot of people will say, "Oh, the DeMark signals are always bearish." I can tell you that back in late September last year, we had market sentiment at 5% bulls, and then a plethora of DeMark buy signals. And I like to see a lot of buy signals occurring at the same time, or sell signals. For example, back in the end of 21, the December of 21, I can tell you, I had subscribers, I had a lot of them unsubscribing because they're like, "You're so bearish and the market looks so good." But my process said we have a real problem coming up, and it manufactured itself pretty quickly on the downside right at the beginning of 21. On the other hand, again, like last September, we had a lot of buy signals. The sentiment was very low. And now we're right now currently around the same place on the opposite side. So I think things are really, really frothy right now. Very dangerous, in my opinion.
Yes, so I mean, I don't disagree. I mean, I look at various exhaustion signals as well, like momentum divergence. That's something I look at quite a lot. And I often, when I get a signal on momentum divergence, it's often the same time when DeMark signals are coming out. I don't actually, I don't actually look at the DMARC, but because people like yourself and that mention it, it's usually happening quite at similar times. But what I find though is whilst you might catch a short-term top in a market with these signals, it's quite hard to know how long that correction is going to last, right? So in an uptrend, it's often very short-lived, the dip. So you can catch it, but if you don't take your money, it gets evaporated really quickly. Whereas on the way down, when you get a buy signal, usually you can get into that and then hold that long for a much longer period of time and actually do quite well with it. Would you say that you've noticed the same thing?
Yeah, I think there's a little bit of psychology in there as well, because one of the things that happens is when you have this like a longer uptrend, like what we've had in the mega cap names, 2% down day, you'll have anybody that was short start to cover, and the dip buyers come in pretty quickly and buy as well. And if that starts to have a series of failures, those dip buyers become less inclined to trust any move lower, and then the shorts will be a little bit more aggressive on the downside. One thing also is there's also this period when you see all the shorts just plug right at the lows of each day, and they're trying so hard, and I saw that earlier this year, and I'm not really seeing it right now because I think that we're in more of a wave 5 type of.
It's because the shorts have thrown in the towel. That's why.
Yeah, I mean that's very true, and you have this huge, and you know more about this than me or really anybody. This zero data expiration option phenomena, that is just, to me, just nuts, and I'm not sure how people are making money in this, and it's not, it used to be just, the retailer meme stocks and all that, but no, there's institutions and serious funds trading these strategies, and with large assets. It's not, it's not the, Dave Portnoy crowd anymore. It's real money. And the problem I see is you're going to have a situation one day where the dealers get so offsides with their delta hedges, and there's a snap in the market, and then those dealers are going to get really caught out, and you're going to have an exacerbation, perhaps on the downside or even on the upside, depending on which way the markets have been trending.
Yeah, I mean, it's a funny one. It's like, I think it can act as a vol dampener for quite some time until it becomes the opposite, right? So the way I see it is that if institutional money is big in zero DTEs, it will generally be a seller of optionality, right? That is the systematic right thing to do generally, to sell options. But because they've been doing that, that has just suppressed the volatility levels of zero DTE to such low levels now that actually, if you have an intraday view, you're getting quite good risk reward playing it via the zero DTEs because they're just so damn offered, right? Because the systematic strategies keep selling them, right?
Right.
But there'll be a point where there'll be a real reason for the market to move 4% plus, and suddenly there'll be no liquidity in zero DTEs, right? So there'll be all this positioning that comes in a wave early in the day, and then something happens, and then it's just like, boom, the 1 day vol's gone from like 10, 15 to like 60, 70, 80, whatever, right? There'll just be no liquidity to trade that stuff. So, and that will to some extent exacerbate the gap that comes due to the hedging. And so I could see that happening and snowballing at some point, but you need like a trigger, just like you needed a trigger with Volmageddon back in 2018, and that inflation data, I think it was job growth data, wage growth data came out higher than expected, turned around yields a bit, and a 2% move turned into a 4% move, and the VIX doubled in a day. And it was all because there was fragility building under the surface in that complex, in that VIX complex, and it just, that was the little spark that blew it all apart, basically. Right? So.
Yeah, I think you're right. And actually, I always get asked the question, why aren't people trading the VIX anymore? Why is the VIX so suppressed? And I mean, I think you've answered it. And the true answer is that all the cool kids are trading short-term dated options, and there's no need for people to look out beyond a month I actually like to look out beyond a month, especially when you have a VIX under 15. I'm more than comfortable to. I just did a triple Q put spread at real low vols. It's cheap right now, and if we do have some sort of snafu with earnings or economic data, or the Fed does something that the market doesn't want, you could have something that really gets the market very, very nervous. And I hate to use the word crashy, but considering that I've seen a bunch of different nasty markets in my day, really nasty, where there's halts and things like that. And if dealers are caught off sides, or if there's a big account caught off sides, it could really be a Volmageddon type of event again. Do you agree?
Yeah, you have to sow the seeds for that type of event. And I think that's what's happening now, right? So we had a period where Vol couldn't get below 18. The VIX was floored at 18 for like 2 years plus, right? After COVID. So that doesn't sow the seeds for that type of event. So now that the VIX has gone and hit a 13 handle, we need to stay there maybe over the summer, maybe even for the rest of this year, who knows? But that's when you sow the seeds for another blow up, basically, right? Where people are so complacent, they don't mind selling downside in the low teens because at the monies are at 8 and it's just nothing's ever going to happen again. And then those positions build and they get bigger and they get bigger. And then that is your dynamite for a real explosion. I don't think we're there yet. I just think we're starting to see the first signs of it. We're seeing skew flattening really aggressively. We're seeing, people scared of the upside, thinking that a bull run has started again. I kind of think that needs to go on for a few more months at least before you've then got some real explosivity potentially. Maybe we get the seasonal September, October weakness that we often tend to see in markets. So you get the summer, people think it's all good. The Fed has somehow managed to thread the needle. We're going to get a soft landing. And then the shit show happens later in the year. Who knows, right? But that's kind of how I could see it playing out.
Yeah, that's very plausible. I'm from California, as I mentioned, and I always look at it like there's always a pre-earthquake before the big one. And I've been through a couple earthquakes too. And it's like, we just had a 4.0 magnitude earthquake, and then a week later you get a 6.0 or something just happens, and it's that shaking of the ground that happens. And a very similar thing, and I don't know if you probably have never been in an earthquake, but I will tell you this: being in an earthquake, you're rattled. You're just your entire body just feels so like stressed out. And a bus drives by your office, and your office shakes, and you think it's an earthquake. It's the same thing, similar to what when people go through those shocks in the market. They'll sell it, on the first shake, and that's maybe what I would imagine happens going out towards October. And looking at the economy and other things like that, I think one thing that people aren't really focusing on is that the comps for CPI are going to get tougher this fall, and the last thing the market wants or expects is the Fed to come back and say, oh, we've got to keep going and keep raising rates. I mean, the market was pricing in rate cuts for June and March, and which made no sense to me. But that I think is going to be, that could be the big problem in the market that could cause everybody just to, hit the freak out button.
Yeah, it's going to be interesting for sure. But let's pivot back towards sort of your sort of style. You mentioned obviously everyone finds their own style that they're comfortable with. Obviously yours is tried and tested for many years. And congratulations on an amazing year last year. I've got many of my subscribers are also your subscribers, and they've told me that you knocked it out the park last year. So tell us a little bit about your kind of risk management process, how you think about trade sizing, what sort of stops you use, do you use diversification, things like that.
One of the things that I preach, and it makes my life less anxious when I'm trading, because there's nothing worse than having too large of a position that causes you to, have to risk manage too tight. So my maximum size position that I will take is 5% at inception. And a lot of times it'll be a 2% sized position. As much as people will think, oh, you can't make any money that way. Well, if you're wrong, you won't lose that much. And with that also, you can give yourself a 10% stop on something, or even more. And a lot of times, if I put on an initial 2% sized position, if I'm still, liking the position or I believe in it, I can add up to 5%, and then I adjust my stop, and I'm able to do that. And there's a lot of hard and fast rules that you got to have a hard stop on this, and there's times where I'll adjust a stop because if I think that the overall market is going to do something with the DeMark indicators that are getting closer to something, I'll hold my stops, and I'll raise the stop a little. I try not to have more than 20% also in one particular sector. And that has been beneficial, because having too much in financials or tech, I think, is a very difficult circumstance when it's going against you. So I'm really conscientious of that. And I look at everything in a very strict percentage terms, and what I'm up or what I'm down. And truth be told, I'm not having necessarily the year I had last year or the year before. I'm down slightly on the year, but I've done this long enough to know that if I miss the front part of the Eiffel Tower trade, I'll get the other side on the downside. And the other thing is also, I work for the hedge fund I was a partner with, and worked with some of the best short sellers I've ever worked with. I credit a lot of what I learned from working with them, and we were net short a lot through the early 2000s. We did great during the great financial crisis. We were down on the year, but only down 0.5% on the year, which a lot of people were pleased with our performance that year. But I will definitely have a set stop. I usually will set it initially at around 5%, and that tends to be my warning signal right there at 5%. And then the sizing
on the. Sorry, let me just quickly clarify. So 5% on the stock. So you might allocate 5% of your AUM into the stock, and then your stock will be 5% on the stock price.
Yeah.
So the actual loss you would take would only be 25 basis points. Is that right?
Right. That's, and we can live with that, right? 25 basis points is not going to crush you. And even if you make 5% on that, you can, I trade a lot, so you can get a lot of those 25 basis point upside gains can really add up. And funny enough, I looked at like last year, and my winning percentage was about 73%. It's about 65 this year. Not terrible, but it's not. I feel like I'm on a treadmill right now, really going nowhere fast. But I think that having those types of stops, and I also will. I have to say, if you have a stop on something that's a really highly volatile stock, you're most likely going to get stopped out of it. So sometimes I'll start with a 2% position. I'll give myself 10% and allow it to wiggle a bit. I think that it's very, very difficult to get the exact perfect top tick or bottom tick on something. So I'll try and use the indicators that I have to get close to that. And if I have to add a little or something, sometimes I'll add to a winning position as well. So I have no problem doing that as well.
Yeah, I've always found adding to winning positions quite hard, actually.
It is.
I'm good at stopping out of losing positions and not letting it turn into a disaster. But adding to something when you've got it, it's moved 10% already. You're like, man, I wish I'd just put more size on in the first place. But what was I going to say to you? So your risk management process obviously is very important. Do you ever use optionality? You mentioned put spreads on Qs. Do you use optionality much to help with your risk management and things like that?
So for the site and what my trade ideas that I do on the site, I will rarely give people option trades.
That's good. It means you're not stealing my business then.
Yeah, no, and I'm leaving it to truly leaving it to the experts. I have, derivative traders that I've worked with for many years that help me with the option trades, that they know the exact deltas that I need and everything. But the bottom line is I have people that are super sophisticated, brand name hedge fund managers, and people that read my stuff, and they get it. They know how to manage things. But I also have a lot of people that are novice investors that will take their entire amount that they have and put it into a put spread that's out of the money, that I'm thinking of it as a hedge. They will think it is the glory days of they're going to become millionaires overnight. And so I'm very conscientious of who I'm doing to do what and how. I do personally with our fund, we look on short positions. I will sell all the time covered puts on shorts and covered calls on longs. I'm different from a lot of other people. Sometimes people, they get called away and they're like, oh, I wish I didn't get called away because I could have made more. I just took a profit. I was looking at it when I added the option, thinking it would be great if the stock's at 30 and I'm selling the 25 put. I just got out at 24 and that's a win, but it's at 20. I don't look back. I mean, that's one thing also. Looking back is a killer for people.
Yeah.
And
so counterproductive.
You and I have been trained in not to look back and say, oh, I should never have done that. I should have kept more. That's just wasted energy.
Totally. Yeah, 100% agree with that. Okay. All right. So now you've been doing this a long time, as we've said. So you must have some good war stories. So why don't you tell us what was your best trade ever and what was your worst trade ever? And what did you learn? Well, we tend to learn more from our bad trades, but what did you learn from them?
Okay, so I thought about this because you kind of prepped me with would you ever think about this? My best trade ever, I bought Cisco. I think it was 1990, and I just was fascinated with the internet, and the internet was coming on strong, and Cisco made the routers and everything for the phone companies, and I thought, if this goes, Cisco's going to be just mega. And I bought Cisco and kept buying it. It was my largest position. I had like a 30% position in it after a couple of years, and I just held on to it. And then my dad was not a investor. My grandfather was a money manager, but my dad was in advertising, and my dad was like notorious coming in late and saying, oh yeah, this Pfizer, this Viagra is going to be really big. And that was the top. But he came in and he said, and this is like 2000, he said, I think this company Cisco is going to be something really big. And I said, Dad, it already is. It's my largest position. I mean, it was like mega. And I had, I bought Leaps in 1998 when the market crashed. I bought Leaps out in Cisco. It was nuts. And I said to myself, you know what, that's a sign. And I started taking the position off, and it's never been back to those levels again. I credit my father for helping me exit that. Nice. So that was a great trade. I will say the worst trade, and it really taught me a lot. There was a company called, I didn't want to say the name because the CEO is probably still around, and he ran several large tech companies. But this company made hard drive assemblies, and I built a really big position for myself. And in the 90s, late 90s, mid 90s, I think it was, I had a fair amount of capital, but I thought I got greedy, and I put a quarter of my portfolio in this one company, and I did work on it, fundamental work. I spoke to the CEO, and this is before you weren't allowed to speak to CEOs, but I worked for a large enough firm that I could get access. And this guy lied to me to my face. Quarter's going to be great. We're just going to knock it out. And they guided lower. It was just an absolute disaster. I was going to use another word, but a disaster. And I lost like 30% on that position overnight. And I just sat at my desk till the market closed in California at 1. I sat at my desk till like 9 o'clock at night. I was so distraught. I was pissed at myself. I was pissed at this CEO. And I said, I'm never going to allow someone to talk to me. I have to be more skeptical And it really taught me to be more skeptical, taught me risk management. Like, you don't need to risk your families on hoping that this thing's going to rip. And I basically changed my thesis. My sizing is all different from there. Risk management. I'm skeptical about CEOs. I think that helps me as a short seller. I avoid hype. So that was a bad trade.
How old were you when that happened?
How old was I? I think I was 31.
31. Okay.
I was 31. And I just got married, and we had just bought a large house, and we were redoing it. And I remember coming home or going to the house, and it was a construction site. It was all plywood and everything. And I thought to myself, this sucks. But it's funny, because I think the lesson is, a lot of times if you just learn from that mistake, you figure out that your legs that just got cut off at the knees tend to grow back, and it takes time to get that back. And it took me over, a while to get that back. And, a lot of times the gambler mentality for a lot of people is to say, oh, I just got mashed in this, in the blackjack table. I just lost $100, so I'm going to take $200 on the next hand and try and make it all back. And that to me is like, no. And grudge investing is terrible too. When you have a grudge against a company and you want to get it back, and you just move on. Don't trade it again, and just learn from it.
Yeah, I mean, exactly. Revenge trading is a recipe for disaster, right? Because that's the whole art of trading, is about understanding your emotions and not letting them control you. And you can make rational decisions based on calculated analysis of data, hopefully, right? Or whatever edge you've managed to cultivate, but you don't let the emotions be the thing that's driving, right? So, and you're right. The times that I've lost the most money are when I've let the size get out of control, and you just end up making irrational moves, basically, right? So I think it does boil down to that in the end.
Yeah, when the larger the size of a position, I mean, if you're in the money and you've got a good cushion, you can withstand some of that volatility. But if it's a newer position and you put on large size, you're on the razor's edge with your P&L. And for my own anxiety, which I recognize my anxiety and my fears and my emotions, and I recognize them so I don't let them rule me. That's really the key. You could sleep at night if you have a diversified portfolio. I mean, for me, I'm very comfortable being net short. Maybe not this, today. I'm comfortable because I have a diversified portfolio, and I know that sometimes you don't necessarily get everything to pluck or pick the fruit from the tree each day. And on a long short portfolio, you're sort of manic depressive because you got your longs working and your shorts aren't. So you have to know when your longs are going up, you can sell into those. When your shorts are going down, you can buy into those. And you have to just have that mindset that you're going to be wrong at times. And
how many positions will you have on at any one time generally? Is there like an average sort of that you have?
It typically can be over 30. Yeah. And I mean, I currently have, I think, 32. And I'm very comfortable, and I try to be always invested. I mean, there's times where I wish I could just say, no, I'm out, but unfortunately, I just don't do that.
Well, at least now, if you're not invested, you're getting some yield on that cash, though, right? Yeah,
now you can. I mean, it used to be you get 2 basis points, and you're like, oh, but now you get 5%. But that, my investors are giving me money to put towards a long-short portfolio, and that's what they're paying for, not a T.
Yeah, exactly. And it's on that last point about sizing, like that's why I love options so much, right? Because when the option goes right, it increases its own size. So I don't need to, like I said to you, I find it hard to increase the position when it's working, but the option does that for you, right? When you buy a call option and it's like 20 delta on day one, and you catch a move and it turns into a 50 delta, then it's grown itself, and then your position's much bigger than it would have been when, or what you intended it to be necessarily. But that's okay because it's doing it by itself, right? And that's what I think is very powerful about options. If you obviously you're paying some time decay for that privilege, but if you know how to manage that and understand that, then I think it can be very nice and give you a lot of asymmetry in your book, right?
Yeah, I would imagine that you, if you have a 20, you probably have your secret sauce as far as, you like to buy a 20 delta call option or put option or something, and if it goes to 40 or 50, you're going to be comfortable probably taking some of your gains off, if not all. I mean, it's hard to get the 100 delta immediately, and that's great, and it can happen. But I think that that's one of the things that a lot of people that trade options that I know, they tend to try and get the home run, where you have to look at it as the same thing as a stock. If you can get a 20% gain in an option, that adds up, and taking some of the risk off matters as well. And that's the thing. I recommended with Tesla a little higher a put spread the other day, and it came really close to it came right to the high strike, the 240 220 put spread. And I told people, I said, it's not in the money, but take some off. You've got a gain, and the balls are so high in that it's a double. You can have a 5x if it works to the lower strike, but you're going to be waiting on that Friday till the very last minute, saying, please God, move lower.
That's the difference between gambling and trading, right? Like if you trade options like a professional, you're not going to regularly make 5x 10x on your option positions, because to make that, you have to let it go to the death, and you have to go smashing through strike and go deeply in the money, right? And that becomes, the closer that goes to expiry, the more binary that becomes, because if you don't get your move and you go the other way, it goes to zero very quickly, right? So you don't, as a professional options trader, you don't want all these trades to just be binary bets on you being right or wrong. You want them to be asymmetric bets that are smooth in their P&L nature, but they give you that asymmetry, and you're picking your entries. But like you say, if you make a double on an option, take half the position off and free ride the rest, right?
Yeah, exactly.
Right?
And
because why wouldn't you do that?
Listen to that, kids. That's sage advice.
Want a chance to speak directly with Imran just like Tommy Thornton here? You're in luck. Our free webinar where Imran will dissect his recent trades and take your burning questions is coming fast on July 11th. So find the link in the video description below and save your seat while they last.
That is absolutely the truth. And if you do get a double in an option, that's a home run in my opinion.
And the beauty of options, you can always roll the strike up, right? So I do this a lot in my portfolio that my subscribers get to see, and it's like we do a trade, it goes well, it works, and we're like, okay, let's roll up the strike, take some money off the table. We still like the trade. It's still got 3 months to go till expiry. And if it keeps going, we'll make money. But if it comes down, we've banked something, right? And it's always about trying to knock a few singles so you've got some P&L to play with, right?
Yeah, that I think is it's underrated in the sense that it's knocking it. For example, just a little baseball analogy here. If you get a lead into the third or fourth inning, and you can, the rest of the game can go a little easier. I try to book some gains early in the month, and then I can push a little harder on some other things throughout the month. There's nothing better mindset wise than when you have a positive P&L for a day or a week or a month or a year. It really affords you to be able to push a little harder. You're more clear-headed, and I'm coming from this angle from the opposite side right now, because I'm down 5% on the year. It's hard being long short right now, and skeptical of AI and all the other tech names that are trading at 40 times sales. I don't chase, and I know that I always look at it like, I'll buy Nvidia and I'll be the last person to buy it. I can't chase that, and I have a bit of a value oriented type mindset from some of the earlier training that I did. So it's hard for me to chase momentum, and it's those that do, more power to them. I mean, they can do it, but for me, I'm always very very cautious of doing that. And with my subscribers, I'm afraid to bag them. Like, oh, we bought too late, and here we are. We
Yeah, I mean, it just feels so shit to do that as well, right? You missed that little parabolic move. You buy it at the top, and it's like, see you later, right? I mean,
and look, we've made all the
or whatever.
We've made all the mistakes that people make. You want to try to avoid those things, and look, I make mistakes all the time, and I know when I'm wrong, and it's like, and I feel a huge amount of responsibility to the people that are, paying to read my stuff. And it's not just the trade ideas, but, for some people, that's what they care about. And
it's guidance, right? You're steering the ship, right? You don't want the crew to end up in the ocean, right?
Yeah, exactly. And again, with sizing and keeping things, I mean, I could say that, my performance this year, it's like, oh, you're down on a year that the S&P is up 14%. I know that when things go my way and I get positioned properly, and let's say we have a 10% down move in the S&P or the NASDAQ, which I don't think is out of the question at all. At some point, we could be, that could be near term. I know that my P&L will notably outperform, and then we catch some down moves, and that's what happened last year. Last year was great because we have these down moves, and you didn't have the tech names holding everything up. You had everything going at the same time, and then you'd get these moves, and all my data worked great. And this year you have a lot of stocks and sectors that aren't doing great. Half the market is not up on the year, or a lot of sectors aren't up on the year. And if you take out those mega cap names, it's sort of like an type year.
So, I mean, I think you've kind of partially answered my next question, which is, so what do you think are the biggest opportunities for the remainder of this year? Sounds like you want to be short tech, or certainly some of these frothy AI.
Yeah. As much as
it's pretty dangerous being short though. So again, I'd recommend put spreads as above outright shorts and stuff like that. Right?
Yeah, look, I get it. And, I tend to look at it in another way. If I look at some of the moves that we have had, some of the overbought conditions and the valuations that have gotten just, ludicrous, I look at it in the other hand and say, and I also look at short interest, and a lot of the short interest is very, very low, and there's huge call buying. I look at that and say, well, people are inflows. I mean, tech inflows have been huge. I look at it that is it's not that risky if I'm shorting NVIDIA after 150% move higher. I mean, I'm not going to be there for a 50% move higher if it does go that high.
Yeah, you got your hard stop anyway, right?
Yeah, I'll stop myself out. And I wasn't short going into the earnings.
That earnings is crazy.
I mean, look, the AI thing, I really think that my 2 cents, I think people have taken existing chipsets or products and reclassified those as AI. And, they put new stickers on the back of the chipsets and data, the data centers are all AI data centers now. Look, that's great, but now it's going to be a real test if they can deliver the earnings. Mm-hmm. And when you have Microsoft and some of the others, that NVIDIA, obviously, AMD, obviously. I mean, AMD just gave out guidance of their last quarterly report that I was short going into, and I covered it on a 10% down move. They didn't even mention AI. Mm-hmm. And then, everybody started, after that, NVIDIA is talking up AI, and then people were saying, well, I guess AMD's have AI, and it's up $60 billion since. And they're never going to have $60 billion in revenue that's going to equate to that. So it gets a little silly. Mm-hmm. And I've been through these silly type moves in markets, and I think we're in one now.
Mm-hmm. Yeah, I mean, to be fair, whenever you see a chart that's gone parabolic, yeah, you know you're in some sort of silly move. The problem is you just don't know where the top of the parabola is, right? That's the
And I've used the mark indicators for 20 plus years, and if anything, when I have those upside exhaustion signals, it gives me a pretty good idea or a basis of where it could top. And if I'm wrong, you pretty much know shortly after that, because you tend to want to get a reversal within 10 days. I know in 10 days, NVIDIA could, double, I guess, but if you use those and you look at what's happened in the past, you have a pretty good idea. And if you're wrong, you just move on and you're wrong. It doesn't, being wrong quickly after having a signal, it affords you that the opportunity to get out with a reasonable loss.
No, it's true. And I think your indicators are very, very good, right? I mean, you've used them for so long. I think you've done a pretty good job of testing them, kicking the tires on those indicators to know if they're useful or not. So
I know when they are most likely going to work properly. And again, I tend to get things right about 3/4 of the time, or a little under 70% of the time.
That's a better hit
when
rate.
You're wrong, you can move on.
That's a better hit rate than most investors, right? Stanley Druckenmiller says he's right 55% of the time or something. So.
Yeah, but Stan will put 25% of his AUM into something, and he he has this thing where if he's he gets very excited about something, he'll get piggish and go mega long or mega short something. Stan can afford pretty sizable drawdown if that was ever to occur, but he's a great, he's the best, 30% for his whole career. Not
Mate,
so bad.
You don't sound like you're too far behind, if I'm honest. So,
Yeah.
You're doing well. But on that note, why don't you tell the people, I'm sure a lot of them already know, but why don't you tell the people where they can find out more about your stuff?
Okay. Well, I'm on Twitter at Tommy Thornton Twitter, tweet about stocks and stuff and all the fun stuff. But my site is hedgefundtelemetry.com, and you can reach out to me. We have a trial that you can get, but I have to enable it or have my people enable it. I'd love to have your subscribers to check it out. Excited about what I do, and you get 3 notes a day. It'll bring you up to speed on things, and I try to be educational. Occasionally, a little snark and humor goes a long way as well. And when I'm wrong, I usually jump on the sword and say, yeah, flat out wrong. And it's not like I'm, I'm emotional about it. I get freaking pissed. But I'm also really excited when we do well and catch one nice winner.
Well, you've been a delight to talk to. It's been really, really nice to meet you. I've always admired your appearances on the Daily Briefing, talking to good old Ash or Maggie. It's just great to finally meet you properly. And I hope we can be in touch and
likewise.
Bring you on again sometime.
Well, likewise. And I love the stuff that you do with Brett, and you guys are fantastic. And I just am envious of the knowledge that you guys have all the derivative knowledge. I mean, it's just, it's all Greek to me, as they say, but
all right, Tommy. Well, thanks. Take care of yourself, and thanks a lot. Thanks everyone for listening. Cheers.